The market has stopped rewarding AI ambition. It is now punishing AI spending. In the last 48 hours, we have seen a massive regime change in how Wall Street values technology. Amazon dropped 11% in a single session, dragging the entire NASDAQ down with it. Why? Because the bill for the AI revolution just arrived, and it is bigger than anyone expected. We just received Q4 2025 earnings from the big three: Amazon, Google, and Microsoft. The revenue beats were there, the growth was there, but the capital expenditure guidance was absolutely shocking. The market has shifted from a growth at any cost mindset to a show me the return demand. We are watching an arms race that is temporarily destroying free cash flow for the giants, while one outlier, Palantir, is showing us what actual AI profitability looks like. Today we are going to break down the SaaS apocalypse, the Capex crisis, and give you updated fair value targets for Microsoft, Amazon, Google, and Palantir. Before we dig into the earnings numbers, we need to address the existential crisis that is driving the sell-off. We call it the SaaS apocalypse. For the last 15 years, SaaS was the greatest business model in history. The thesis was simple: you buy seats. A company hires a sales rep, you pay Salesforce $150 a month. You hire a designer, you pay Adobe $60 a month. You hire a project manager, you pay Asana $30 a month. It was predictable, it was sticky, it was high margin. That model just died. This week, reports surfaced regarding Anthropic's new cloud cowork capabilities. And if you haven't watched the demos, you are missing the single biggest deflationary event in tech history. These aren't chatbots that summarize your emails. These are autonomous agents that have computer use privileges. They can take over a mouse and keyboard. They can log into SAP, navigate the menus, extract the invoice data, open your email, attach the file, and hit send. Think about the math from a CFO's perspective. If an AI agent can execute the workflow of 5 junior employees, I don't need to hire those 5 people. And if I don't hire them, I don't buy their software seats. This is seat compression. The market is realizing that 30 to 50% of enterprise software revenue is tied to human fingers hitting buttons. If you replace the human, you delete the seat. Furthermore, this destroys the user interface moat. For years, companies like HubSpot or Workday won because they had nice dashboards. But AI agents don't need dashboards. They don't need pretty buttons. They just need the raw data. If the user interface is no longer necessary, then these software companies are just glorified databases charging a 90% premium. That premium is about to evaporate. This is why Microsoft, Amazon, and Google are panic spending. They know the app layer is getting commoditized. They know the value is moving to the agent layer. They are spending hundreds of billions on GPUs, not because they want to, but because they have to. They are racing to own the operating system that controls the agents before the software companies they host become obsolete. But building the brain of the future is incredibly expensive. And that brings us to the earnings disasters we saw this week. Let's look at the damage. The story of Q4 isn't about revenue misses. It's about a massive divergence in business models. We're seeing a split between the CapEx casualties who are building the factory and the capital efficient who are just running it. First, Amazon, AMZN. Headline numbers? Solid. They reported $213.4 billion in revenue for Q4, up 14% year over year. AWS re-accelerated to 24% growth. If this was 2021, the stock would be up 10%, but yesterday it crashed 11%. Why? Because of one number, $200 billion. That is their projected capital expenditure for 2026. To put that in perspective, that is roughly the GDP of Greece spent in 1 year. They're pouring this into custom silicon, Trainium and Inferentia chips, robotics for fulfillment centers, and massive data center expansion. The market hated this because it destroys free cash flow. Amazon is saying, trust us, we need to burn $200 billion now to own the next decade. Investors are saying, we don't trust you that much. Next, Alphabet, Google. Functionally, Google is the best performing business on this list. Google Cloud revenue hit $17.7 billion, growing nearly 48% year over year. They are now growing twice as fast as AWS. That is a massive market share shift. But the stock still dipped. Why? The same disease, Capex inflation. They plan to double their spend in 2026 to nearly $185 billion. The market is asking a very fair question. If your software is so good, Gemini, and your growth is so high, 48%, why is your capital intensity getting worse? Wall Street fears that search profit margins are being sacrificed to fund an AI war that might never end. Microsoft, MSFT, is in the middle ground. Azure is growing 39%, stronger than Amazon, but trailing Google. The problem here isn't disaster, it's saturation. Microsoft has been the safe AI play for 2 years. But with flat margins and rising competition from Claude, the easy money phase is over. They are running to stand still. And then we have the anomaly, Palantir, PLTR. Palantir is playing a completely different sport. Their revenue growth is accelerating, pushing 20 to 25%. In the U.S. commercial sector, they are growing north of 40%. But look at the Capex line. It's a rounding error. Palantir doesn't need to buy a million H100 GPUs. They don't need to build nuclear power plants to run data centers. They just write the software that runs on top of Amazon and Microsoft's infrastructure. While big tech is destroying their margins to build the AI electric grid, Palantir is just plugging into the wall and selling the appliances. They are GAAP profitable, their margins are expanding, and they have zero Capex hangover. This is why Palantir is green while the rest of the sector is red. It's the only AI trade that is actually generating cash right now, rather than consuming it. Let's simplify all the noise. The market is effectively dividing these 4 stocks into 2 warring camps, the factories and the architect. First, the factories, Amazon, Google, and Microsoft. Think of these companies as the utility providers of the AI age. The bull case? They own the land. They own the power. If the AI revolution happens, it happens on their servers. They collect a toll on every single API call. It is the ultimate volume business. The bear case? They are taking on massive Capex risk. Here is the dirty secret. The H100 GPUs they are buying for billions today? They might be obsolete in 18 months. These companies are running on a hamster wheel of depreciation. They have to keep spending $200 billion every year just to stay relevant. If demand slows down for even 1 quarter, that depreciation destroys their earnings. Amazon is at very high risk here. They are betting the company on this build-out. Second, the architect, Palantir. Palantir isn't trying to sell you raw compute power. They're selling you the result. The bull case? This is pure operating leverage. Once Palantir builds their AIP platform, deploying it to the next customer costs almost nothing. They don't need to buy more generators. They just send the code. They are selling outcomes, saving a hospital money, winning a battlefield, predicting a supply chain break. That is infinitely more sticky than selling raw cloud storage. The bear case? Valuation. Quality is never on sale. You are paying a massive premium for this efficiency. Palantir trades at a multiple that makes value investors woozy. But here is the reality of the market right now. Wall Street is terrified of Capex spending. They want growth, but they don't want the bill. The winning formula in this tape is low Capex plus high growth. Amazon has high growth but massive Capex. Google has high growth but massive Capex. Palantir is the only company on this list that checks both boxes. That is why it's acting like a safe haven in a tech wreck. So, what do you do with your portfolio right now? Here is the plan. Number 1, avoid the Capex trap. Be very careful with Amazon right now. The market is in a show me mode, and Amazon has told us they won't show us the money for another year. Number 2, the value play is Google. If you have a 3-year horizon, Google trading at these multiples with 48% cloud growth is mispriced. The bull case of $370 is realistic if Gemini 3 delivers. Number 3, the momentum play is Palantir. It is the only stock confirming the thesis that you can make money in AI without burning cash. Buy the dips. Final thought, the market is quietly saying one thing: show me AI revenue, not AI spending. Palantir is checking that box, and Google is close. Position accordingly. Thanks for watching. If you found this helpful, subscribe for more institutional grade analysis. I'll see you in the next one.